On October 20th, 1973, at 2:15 p.m., the phone rang in the Oval Office. Saudi Arabia had just cut off all oil to the United States. Within hours, gas stations across America ran dry, and the world's largest economy began to seize up. The embargo was retaliation for U.S. support of Israel during the Yom Kippur War, but the roots went deeper. For decades, Western oil companies had controlled Middle Eastern crude, setting prices and production levels. Now, the producers were seizing control, and they used oil as a weapon. 3 days before the embargo, on October 17th, OPEC's Arab members met in Kuwait City. They agreed to cut production by 5% each month until Israel withdrew from occupied territories. But the real decision was made in a side room. Saudi oil minister Ahmed Zaki Yamani convinced the group to target the U.S. specifically. Yamani, a Harvard-educated lawyer, understood that America's oil addiction was its Achilles heel. The U.S. consumed 17 million barrels a day, a third of the world's supply, but produced only 11 million. The gap was filled by imports, mostly from the Middle East. Yamani's strategy was simple: squeeze the spigot and watch the giant stumble. The embargo worked through a precise mechanism. First, production cuts reduced global supply by 7%. Then, the targeted embargo on the U.S., Netherlands, and others created panic buying. Oil companies scrambled to secure non-embargoed crude, bidding up prices. But the real choke point was the U.S. quota system. In New Jersey, truckers blocked highways to protest fuel prices, their livelihoods evaporating with each price hike. In Detroit, auto workers were laid off by the thousands as demand for gas guzzlers collapsed. The stock market lost 45% of its value in 2 years. But the deepest cut was to the American psyche. Behind the scenes, a little-known figure pulled strings. James Akins, the U.S. ambassador to Saudi Arabia. Akins had warned Washington for years that the Saudis would use oil as a weapon, but he was ignored. In a classified cable on October 12th, he wrote, "The Saudis will cut production unless we pressure Israel." In June 1974, Secretary of State Henry Kissinger brokered a secret deal with Saudi Arabia. The Saudis agreed to price oil in dollars exclusively and invest their surplus in U.S. Treasury bonds. In return, the U.S. guaranteed military protection and arms sales. This pact, buried in a bilateral agreement, stabilized the dollar but made the U.S. dependent on Saudi goodwill. While Americans fumed in gas lines, the developing world was devastated. Countries like India and Tanzania, with no oil reserves, saw their import bills triple overnight. They borrowed heavily to pay for energy, leading to a debt crisis in the 1980s. The World Bank estimates that the oil shock pushed 100 million people into poverty. The 1973 crisis teaches a timeless financial lesson. Concentration risk is lethal. The global economy had bet everything on cheap Middle Eastern oil, ignoring the geopolitical risks. When the bet failed, the losses were catastrophic. Today, we face similar concentration risks: rare earth minerals from China, semiconductor chips from Taiwan. In 2022, when Russia invaded Ukraine, oil prices spiked again, and the same panic set in. But this time, the U.S. was less vulnerable thanks to shale oil. Yet the petrodollar system remains, and Saudi Arabia still holds sway. The 1973 crisis was not an anomaly. It was a preview of a world where energy is weaponized. So, how did a handful of desert kingdoms bring the industrial world to its knees? They understood a simple truth: control the supply of a vital resource, and you control the world. The U.S. had ignored warnings, underestimated its vulnerability, and paid a devastating price. The open question remains: what is today's oil? The single point of failure we're blindly depending on? What would you have done? Tell us in the comments. Subscribe to Noir and uncover the stories money try to hide.